evening all. We have Alumni Association and the Department of Mechanical Engineering welcome you for the 87th webinar talk, Understanding Blockchain and Cryptocurrency for Beginners. We welcome our principal ma'am, speaker of the day, Mr. Krishna, faculty members, current students, and all alumni friends. Mr. Krishna belongs to the 2003 batch mechanical branch. After his engineering, he worked with 24/7 customer as a customer satisfaction performance management executive for 1.5 years. Then he worked with Object ORB Technologies as a senior SQA engineer for 1 year. Then with Y as head quality and operations network business line for 7 years. Then he was with TP Vision as senior manager quality for 7 years. Also in parallel, he has completed his master's in consultancy management from BITS Pilani. He is currently heading the program management of Swiggy's revenue and growth vertical, new initiative vertical, and the storefront vertical for the past 3 years. Sir, we are all eager to know from you about the cryptocurrency. Over to you.
Sure, thanks a lot. And then hope all of you all are safe. I will probably, I think I'll tell the scope of what I'm planning to cover and what I'm not planning to cover. One is, I think this is a very new, on the tech side, something very new, and this is going to be the future. And I think a lot of people don't understand it completely, and there are many people who are playing in the crypto market and treating it as a normal NSE BSE exchange kind of trading and this thing. But I think the potential of blockchain is quite high. So in this session, I will be oversimplifying everything, and I will probably start from the history so that we understand the context of why this has come, and I will oversimplify it so that it is understandable for everyone. So this is like in history, what's most important is to understand the what happened, why it happened, and then what we learned from it rather than the dates. Right? Similar to that, I will be oversimplifying a lot of things, and if this interests you, you can look at read those materials. Probably you can get in touch with me, or then maybe we can have another talk where we do a deep dive session to understand this whole thing. And I'm not going to talk about what crypto to buy, what crypto to sell, etc. It's not a trading class. It's not nothing to do with investment. It is about the conceptual view on cryptocurrency and blockchain. So what
nice
I would
disclaimer.
Sorry,
I said nice disclaimer.
Yeah. So in case people are disappointed, I mean, I would like to save their time. So probably, they can do something else. They are not going to get buying recommendations. So that's about it. So I will be talking about some of the consensus mechanism. What is the blockchain? Different proof of work, proof of stake. Those aspects of it is. If we get time, I'll talk about DeFi. Those are the emerging things and very powerful things that is coming together. So before I get into the blockchain part, I would like to look at something about history and economics, because it's very much connected with economics. So we all know about the 2008 crash. So what used to happen is what these bank people used to do is when I as a person buys a mortgage, a loan from the bank. Usually the bank from which I buy don't keep the loan for themselves. What they do is they package it with other loans and they sell it to some other bank, and that bank may package it further with some other loans and sell it to other banks. So these were the new inventions from the in the financial markets. Typically when anyone gets a particular loan, you look at the credit rating, you look at how well the person has done, and etc., and then you give a loan. As how the financial markets were there back then in 2006, 2007, this thing, people all looked at, hey, how can we make more money than what we are getting right now? So that's when they got this idea of why don't we package these it's called mortgage backed securities. So we basically combine probably 10, 15, 20 different mortgages from different sets of clienteles, so that the probability of a default of everyone is low, and then let us sell that security to people who are interested. And they found that once they did this, a lot of people across the globe were interested. So it was not just within US, it was across the globe. So everyone started buying, because for everyone it was very clear. I mean, come on, we are looking at a package, a bond of a particular set of a security of a particular set of loans, which is backed by housing. So if there is a default, then there is an asset that is backing it, so definitely we will get paid. So it seemed to be a very safe instrument. So what happened, everyone started buying this, and then the financial the investment banking people realized that, okay, there's so much of huge demand, so let's start giving more home loans. Let's start looking at how do we repackage this better. Slowly with time, what happened is the credit rate, people stopped looking at credit rating. So it went to a level where you could just walk into the bank and say, I need a home loan, and then you just get a home loan. No one bothered to check whether I have what has been my repayment history. Am I credible enough to am I earning enough to even make a monthly EMI installment, etc. All that was thrown out of the window, and people started giving loans. And because there were people were getting free loans, they were ready to pay any amount of money for the home, due to which the housing market also started rising. So you buy one house for say $200,000, and then in 1 month time it's got like a 20% increase, and then another 20% in another 3 to 4 months. So it would only be a fool who wouldn't go and utilize this opportunity. So a lot of people went in the garb of, okay, let's give a home for everyone, and then people started buying. All these investment bankers, they started mixing these loans. So you had a AAA rating loan. Inside that you put a AA, then a B minus, etc. You started repackaging these loans and started selling them at higher interest rates, because they are kind of the risk of default was more, so the interest rates were higher. So they started selling, everyone started buying, and then some of these banks thought, okay, now why don't we also take an insurance? What if there is a huge collapse? So they went to AIG and etc., and they got insurance in case there's a collapse. That insurer will pay back the bank, so bank is not affected. So this was the case, and around 2007, late 2010, 2008 is when we started seeing slowly the defaults happening. Because obviously you're giving someone a loan where they don't even have a job, so they cannot pay. So slowly these things started coming, and then it became a ripple effect. And then at one point of time, you had so many of these defaults that the housing prices started collapsing. So although it is backed by an asset of a house, you buy something for 200,000 whose actual value is like probably 100,000, then you can't get the money back. So that was when this whole financial crisis happened, and then US government had to step in, and then they had to bail out these banks. And how do they bail out? And then you had the economic crisis. So what do you do during the economic crisis? How do you there are people who have lost their jobs? You need to give them money so that they can make a living. You have to encourage businesses to again reinvest, and then start new businesses so that people will get the job. So you start injecting money. So the US government started quantitative easing. That's just a fancy term to say that you just keep printing money. So they started printing money, and then which meant very cheap loans, so that there is a recovery in the economy. Now the effect of all these printing leads to inflation. So we can relate that situation to what's happened in March 2022. Now in fact, if you look at it, the money supply in US has gone up by 40%, to around like $21,638 billion dollars is the money supply that is right now. And the depth, so all this doesn't come free, right? So the depth is around, I think US is right now at around $30 trillion dollars. So if I can put in the chat, I will just put a link. You can actually look at this. You can look at this now or later. This gives you the actual the depth that is it's a clock, depth clock. So currently it's at 30 trillion. So you keep printing money and borrowing money from everyone. This is, I'm talking about the US government, right? The whole economy is just now living on a hope that US can pay back all this money. So this is the actual situation that happened. Now, why did we get to this situation? How is it that the government can keep printing money as and when they like? Is because sometime in 1971, Richard Nixon removed the gold standard. So earlier gold used to be dollar used to be pegged to the gold. So you just can't keep printing money. You have to have gold, and then you can take a dollar and get a gold from the bank. That was how it was. He removed it for various reasons, for the same thing that government can have more control to do quantitative easing. So all this caused a lot of collapse. And around this time is when Satoshi Nakamoto, he or she, we don't know whether it's a he or a she, is the one who kind of invented the so-called Bitcoin that we are talking about now. He realized the level of corruption. So if you dig in deeper to what I told, you will see that there was a lot of corruption in this whole system, right? So he wanted to bring in a trustless cash mechanism and bring a peer-to-peer mechanism where there is no third party involved. So there is always a corruption when there's a third party involved. So how can I build a system which is cashless, which is controlled by the common man, and there is no central party involved in it? So this is what he wanted to achieve. And then he wrote the Bitcoin white paper in 2008. So if you just search for good Bitcoin white paper, you will get to know it's not a big document. I think it's 6 or 9 pages only. He writes about it. So he didn't do anything new. He just picked up different concepts that was already there, and then he brought it together, and then he wrote this wonderful paper, which till today, 12 years or etc., no one could refute it. So he did this, and one of the things about Bitcoin, what he wanted Bitcoin to be, which it still isn't, is where you can make payments and buy things, and there's no government control. So he wanted to bring in a lot of determinism in the system. So there can only be 21 million Bitcoin that can be mined. Post 21 million, there is no Bitcoin mine. So this supply, which the government used to keep, even now the governments are doing it. As I was telling you, there's 40% increase in the last 2 months. I mean, in the last 2 years by US. So this excessive printing of money cannot be done in a Bitcoin. After 21 million, it is done. So the supply is limited, and how limited, when it is going to get over, how many Bitcoins will be mined per 10 minutes, everything is there in code. So it's like the code is the law. Basically, if you look at it, that's what the logic behind this. Everyone knows how the system is going to work, and you have to work with it. You can't change it. And he wanted to bring in decentralization because to remove the third party, right? So we will see how blockchain supports all this. So what decentralization means is, right now, anything that we are doing is very centralized. Like even though internet is there, but if you look at it, we have data centers. If you want something, let's say if you're hosting it on Amazon, then it's on Amazon data centers, or it's in Google data centers. So there is always a central entity controlling it. Now they can decide, if they shut shop, we've lost our data. Or if they decide, no, one fine day, no, Krishna should not have access to let's say a Facebook, they can definitely take me out of it. I mean, we have seen it with Trump being completely taken off Facebook and Twitter. These are happening because you give control to a centralized entity. So his idea was, how do I decentralize it so that this information or whatever I'm planning to do in terms of Bitcoin is, there is no central entity to control it. By the way, if you have any questions, you can stop me, because I'm not sure whether the time will be enough. So we can have follow-up sessions also, but just to be sure that everyone understands, so you can stop me and you can question me in case you have
I have one. How did he fix it at 21,000?
Why 21 million Bitcoin? I am not sure. Why did he come up with that number? I'm not sure about that. But 21 million is the
Okay.
is the number that it's 21 million.
Okay.
Right. So now coming to how did he do this? He just used a mechanism called an open ledger, which is, now we are coming to the blockchain world, right? We looked at why and we looked at what his objective was, and now we are looking at how did he do it. So the mechanism that he used was something like an open ledger. So you can assume the open ledger as one Excel sheet. Now every transaction that happens in that blockchain, which means anything in the Bitcoin, if I want to send a Bitcoin to Thomas, or or Thomas is sending a Bitcoin to me, every transaction has to be recorded in that. So there has to be a debit and a credit in that open ledger. So think of it as an Excel sheet. So you have row 1, I'm sending 1 Bitcoin. So from mine, one Bitcoin should be minus, and from in Thomas, 1 Bitcoin should be plus. Thomas is buying coffee for probably 0.0001 Bitcoin. So then that has to go from his wallet, and then it has to reflect in the other person's wallet. So this whole thing, every transaction will be written in this. You can think of each row in the Excel sheet. And this is viewable for everyone. So even now, if you pick up anyone's Bitcoin address, you can kind of see what they have, how much money is there, what transaction it is. So it is actually open and it is not secret. Now the question comes, who can write? So this, in this Excel sheet, we instead of blockchain, I will use Excel sheet just so that we can envision it easier. So in this Excel sheet, only few people can have write access. No one can have modify access nor delete. Once written, it is written, and so only few people can do this write access. Now, who or what mechanism do we choose to give someone a right to write something on this is the question now. So that is decided by something called a consensus mechanism, which is a proof of work which is used. We will look into what it is, right? But basically what we need to know is every transaction will be written in this Excel document. No one can change this Excel document. Everyone can view this Excel document. And there is some rule to how a person will be chosen to write on this Excel document, right? That is what it is. Another thing about decentralization is, because here this ledger, what we are calling it as an Excel sheet, is not staying in one central server. Like I can run a Bitcoin full node here on this laptop. There could be someone in US, there could be someone in Europe, etc. So this copy of this ledger is distributed across the world. So there is no one single place where this ledger is stored. It's stored everywhere, which is why no government can ban it, because there is no owner to it. So whom do you go arrest? There is no one. We don't know who Satoshi Nakamoto is, and we don't know who is. There is no central person who's owning it. So you have Bitcoin is the most decentralized cryptocurrency right now. So no government can block it. The only way to stop Bitcoin is to shut internet across the globe. That's the only way. So because of this mechanism, it gives a lot of control to the people who are holding the Bitcoin, because no government can handle, government or any agency, right, cannot block it. So we spoke about now about writing it. Now there is some mechanism by which we choose who can write this to this block. Now why will someone want to write? They have to be incentivized. You have to, I will not do anything for free. I have to gain something, only then I will take the responsibility to write it. So that incentivization happens through a crypto payment to me, right? So in the Bitcoin's terms, if I am the one, if I choose to be a person who wants to write something to that blockchain or to that Excel, then I can call myself as a miner. So if I am a miner, then MINER, if I am a miner, and then if I want to write, and if I get the opportunity to write, currently I get some 6.25 Bitcoins. And every 10 minutes, this ledger is written. So every 10 minutes, there is someone around the globe who is getting the opportunity to write the transaction on a ledger, and they're earning 6.25 Bitcoin. So this 6.25 into 10 into etc. when you put, you will get to know when the 21 million is. I think 21 million is probably like 50 or 80 years from now or something like that. Right? So far, there is 18.9 million Bitcoin is what is mined so far. Right? So now we know what a ledger. Ledger is an Excel sheet. Someone can write how they are selected for writing. We will see now. And why are they writing? Because they get incentivized by paying in whichever crypto it is. We are talking about Bitcoin blockchain, so it's a Bitcoin that they pay. There are also different types of blockchains. The father of everything is Bitcoin. So even if you're looking at investing or playing around in the crypto market, you will find that every other crypto will follow Bitcoin. Like if Bitcoin falls, every other crypto will fall. So in the terminology in the crypto market, Bitcoin is Bitcoin, and every other coin is called altcoin. And each of the other coin, there are different names. Like I think, I mean, one of the like most famous is Ethereum, Ether. So Ether is one blockchain. Solana is another blockchain. Cardano, Binance. You have many blockchains trying to solve different problems, but they are all of them kind of follow the Bitcoin. And Bitcoin has proved its mettle by no government could ban it, and no matter of any bear market, Bitcoin has survived. Whereas other coins, they are there in a bull market, you will hear, and then in the bear market, the crash can be up to 90%, 95%. Some coins they just disappear off because the developers just move to some other this thing, right? So there are multiple blockchains, is what I want to bring out here, right? We are talking about.
Sorry, Krishna, sorry to interrupt. A quick question. So, you were mentioning that for each ledger transaction recording, right, the miner gets like 6.25 Bitcoins or something like that, right? So, is this number determined based on the transaction that is being done? Like, let's say, like you do a 200 Bitcoin transaction, right? You have the miner gets like 6.25 or whatever it is. So, or irrespective of the amount, even if it's a small ledger transaction, you get 6.25. So, how is that?
Yeah, so there are two fees here. One is the mining fees, which is 6.25. Then there's a transaction fees. So transaction fees will depend on the complexity of the transaction. That is minimal. That's not like as big as 6.25. So there are two fees involved. Like in Ether, you will call it as gas fees. So if it is a very complex transaction, you have to pay more money. If it is a very simple transaction, lesser money.
Thanks, got it.
Right? Yeah, and the 6.25 is currently, so how Satoshi Nakamoto is like planned it is every 4 years there is something called a Bitcoin halving. So when a Bitcoin halving happens, the number of reward that you get as a miner also halves, and basically he's done it in a way that it is not in a very linear fashion that the Bitcoin gets burned down, but it lasts for quite a long time. So this bear and the bull market that you see in the cryptocurrency, you will have to relate it to Bitcoin halving. So the last halving happened in 2020. And what happens is when a halving happens, the number of Bitcoins that is minted becomes lesser. Before that, I think it was 12.5 or something is what a miner got, because when a miner mines a Bitcoin, which means a new Bitcoin is created, there is more supply in the market, right? And then he will be selling that to make money to run his operations, right? So every 4 years there is a Bitcoin halving that happens, and when that halving happens, because there is less Bitcoin circulating in the system, within 3 to 6 months post that is when your bull market starts. So because there is less Bitcoin in the system, people become greedy and they try to buy more, and there is demand more, and then the Bitcoin prices rises and all the other altcoin prices rises. And then after 1.5 years to 2 years, which is around this time now, is when slowly everything will start falling. People will hope that it will last, but then it falls. Anyway, I kind of went to the trading part of it, but yeah, to answer your question, there is mining fees and transaction fees.
Thanks, Krishna.
Yeah. So we were talking about multiple multiple other blockchains that we have. So Bitcoin is one. Like that, there are multiple other blockchains. Now, each of these blockchains have their own consensus mechanism. Consensus mechanism is a mechanism with which we choose who gets the right to write into the ledger, right? So Bitcoin uses proof of work. Bitcoin and Ethereum right now uses something called proof of work. So what the proof of work mechanism does is, when multiple transactions happen, all that becomes one block, and that one block is cryptographically there is what do you call secured, and someone will have to break the cryptographic code. And how that is done is through brute force, which means let's say there's some random number 118567889. Right now, someone will have to generate that 1856789. If they generate the right number, then they will get the right to write onto that ledger. So that is how it is done. So the point is, when these transactions are bundled into one block, and then it is sent to the block, so all the miners across the globe will be trying to solve the cryptographic puzzle. The one who solves first will get the right to write it, which is why when Bitcoin started, and he's also built it in such a way, this cryptographic puzzle, the complexity of it increases and decreases depending on the number of miners that are available. So if you have only few miners available and you find that they are not able to crack it within 10 minutes, then the complexity reduces from the next set of blocks. If it becomes too easy, then it automatically becomes more complex, so that 10 minutes is the approximate time that is looked at. So all this is something that he's thought of and he's built, which is why right now you have this ASIC thing, and then people are talking about the electricity consumption and etc. Because the you need to have so many high-end computers specifically programmed for this to crack those cryptographic puzzles. Just with our laptop, we cannot do, right? So this is the how proof of work works. So you have so let's say I am sending a transaction to someone, like that there are so many people across the globe. Some of that will all become into one block, and that block is cryptographically locked, and then it is sent. Miners across the globe tries to solve it. The moment they solve it, one of that miner will get the opportunity to write to it. They will write to the ledger. They'll get the 6.25 Bitcoin, and they are done. And then by the time the next block comes, so that's how this proof of work is done. That's how the consensus mechanism of this is done. We can get into the nitty-gritties of it, like what happens if someone writes a wrong thing and etc. Probably we will not have time to get into that, but this is proof of work. The problem with this is you need to have these high computing computers to get this solved. So I think sometime in 2017 or 2018, one person came up with another concept of consensus mechanism, which is called a proof of stake. So what proof of stake looks at is, if here what we are trying to do is we are trying to find out what's the correct consensus mechanism to allow a person to write to a ledger. That's a problem statement. So proof of work is using high complex cryptographic puzzles. The other mechanism is proof of stake. So in proof of stake, what happens is, like if you take Solana or Cardano, those uses proof of stake. So there what happens is, you form a community, and then you can have multiple people locking up their coins. So it could be like 10,000 coins, 50,000 coins, etc. They lock up that coins, and then they say, hey, I'm ready to participate in being able to write to the ledger, and this is the number of coins that I am locking. So depending on the number of coins that they are locking against the overall total, the probability of them being chosen to write depends on how much they have locked, right? So let's say that there could be a person who's locking 10% of the overall listing. So he has like probably a 10% chance of getting it. Another person who's locking a lesser amount has a lesser probability of getting it, etc. So now when I get to write something, so let's say, so this is chosen by random, whereas in proof of work, it is not by random. It is about solving a puzzle. Here it's a random logic that is there. So let's say I am the one who's been, I'm a validator. So this is called a validator. There we call a miner. Here, the person who puts there and locks their coins is called a validator. So if I'm a validator who's been chosen randomly to write the next transaction to the blockchain, I get an opportunity to write the transaction, and then I also get paid the transaction fees for that. Now there can be a situation where I can probably be a bad actor. I can make some changes which shouldn't be done. So in case I do something incorrect, which anyway everyone can check the checksum, so if there is some problem, people will know. So if I am a person who's done some changes to that data, because here it's not cryptographically secure, if I make a change to that data, then because I have locked this stake, I will lose this complete stake. Again, different blockchains have different, certain things 30% slashing, it's called slashing. In certain things it's 100% slashing, etc. So that so this mechanism ensures that I don't become a bad actor, and if I'm chosen to be written to if I'm chosen to be able to write to it, I write the correct information of what I have and not turn to a bad actor. So this is the proof of stake consensus mechanism. The advantage of proof of stake consensus mechanism is you don't need that much level of computing. You can just run a server anywhere, and then you can get it done. You can run it in your laptop, and you can get it done. So the issue with Bitcoin proof of work kind of consensus mechanism, you don't have it proof of stake. And let's say suppose you just have let's say let's take Solana, and you're having only 10 Solanas, right? That's like probably around 10,000 USD or something, and you want to participate in this validation. What you can also do is there can be a validator pool. So I have 10,000 Solana, and then I am opening up and telling other people, hey, if you want, you can contribute to my pool, and which means my size of the pool will increase, which means the probability of me getting chosen to write on that will increase. And then when I get a transaction fee, I will pay you a particular amount of depending on your stake, what you have done, right? So that's called pooling you're staking it on a pool in a validator pool. So this is something which is much better from a proof of work point of view, because if you're owning some coins, you can actually, it's like putting your money in a bank account and then you're earning interest. So if you're having Solana, you can stake Solana to some validator pool, because what you need is like huge amount to be a complete validator. So you can put it there, and then you will be getting interest in terms of Solana itself. So your money is making more money by itself, right? So this is the proof of stake. Like that, there are few others like proof of history, etc. But generally, this is how the consensus mechanism works. If there are no questions, then I'll go to the practical uses of blockchain.
So Krishna, quick question. So the Solana, right, the consensus mechanism that you were explaining, right? So the person has to hold Solana, right, even before, right, doing the validation.
Yes.
So you're saying like typically, right, like let's say like, so the numbers keep increasing, right? So for example, Bitcoin has a limit of 21 million, right? But Solana do not have a limit. So which means, right, the more and more, right, how is this generated, right? So I mean, like you were mentioning, like after someone acquires Solana, right? Okay, let's say like he has like probably, right, 1% of it. I'm just putting some numbers, right? So the probability of him getting what to say, like that validator or whatever it is, okay, is high, right? But if the first thing is, right, how is this first of all created, and then why is this number keep on increasing, right? And why there is a limit for Bitcoin and not for Solana? So throw some light on that.
Yeah, sure. So that totally depends on the tokenomics. So that's called tokenomics. That depends on the tokenomics of how that blockchain wants to work on. Like if you take Cardano, Cardano has a top limit. I don't remember offhand what is the limit, but like the 21 million of Bitcoin, you have a top limit of that. So that's the tokenomics on which they work. The tokenomics of, so that will depend on each blockchain. If you take Matic, in fact, Matic is by an Indian guy. That's a layer 2, this thing which helps Ethereum. That has very high inflation because they keep generating new Matic tokens very frequently, right? So that's a tokenomics part of it. That you'll have to look at it into each of the coin on what the tokenomics is, whether it makes sense for you to get into that ecosystem or etc. Because these
is that
other
determined by the inventor? Is that determined by the inventor of that coin? Like how many coins you could just have?
correct.
Okay.
By the team. I mean, there are like there are tokenomics where there is no limit. They'll keep printing. So that is just like the current monetary system that we have. You can print how many ever dollars that you want, right? So like that, there are coins like that. Many coins are like that. So those are the things that you will have to investigate and see what your need is. Because Bitcoin's use has been mostly, I mean, right now it is like a store of value. So it's considered like a digital gold, whereas the likes of Ethereum and other this thing, they are not looking at store of value. They are looking at utility. So probably the next session, that's what I would like to cover on the utility part of it.
Great,
so
great.
in short, tokenomics is what you need to search for the coin that you want and why they have done it and what's the benefit of it.
Sir, I have some queries. Sir, is it audible?
Yes.
Yes. Sir, you said there is no owner for the Bitcoin. Is it right? No, sir. If means, who will gain that transaction charges and the mining charges? It will reflect to the whom's account, sir?
So whoever gets that opportunity to write to the ledger, that person gets it. So if I am a miner, right? So everyone is not a miner, right? Because miner means you need those ASIC machines and all this stuff. So everyone is not a miner. So whoever is able to write to that blockchain ledger, which in Bitcoin's case has to be a miner, that miner is the one who will get the money. So let's say I want to transfer some money to you. So when I'm transferring some money to you, I need to pay some small amount of money as transaction fees. And that transaction fees goes to the miner who is writing it in the blockchain.
Sir, then nowadays, if it is Bitcoin, the price is getting increased day by day as per the market. It is no, sir, gaining and it is getting reduced, no, sir. So this fluctuation, who will decide this? The increasing and the reducing of Bitcoin, who will decide this, sir?
So there is two things here. One, Bitcoin does not increase or decrease. Bitcoin goes by what is the number of Bitcoins that comes is 6.25 per 10 minutes as till another 2 years, right? So the supply of Bitcoin doesn't change. What is changing is the price of Bitcoin against the fiat system. That is completely dependent, just like stock market. If you look at stock market and say, okay, why is Tata Elxsi's share price up by 5%, tomorrow down by 10%? It is completely demand and supply. If you're ready to pay more to buy for a Bitcoin, then someone will sell it to you. If there are not many people who are ready to buy at a higher price, they will sell. The price will drop. So that's demand and supply. And from a probably your question is, if you are a miner, why would you want in Bitcoin? Because the price, let's say price has gone down by 30%, why would you want Bitcoin, right? That's probably why you asked the question. So the ecosystem is Bitcoin in this case. So you cannot compare that ecosystem to an outside monetary system, which is money, which will keep changing. So a person who is doing this mining believes in Bitcoin, and probably they may not sell it right now. They may hold on for when the prices are higher and then they sell it. Or sometimes when they really need money, they sell. So when a lot of miners sell, then again there'll be a crash. So that's just working like a stock market.
Thank you.
So Krishna, one more quick question. So, so when I look into something like coin-based, right? So it says, right, okay, like let's talk about Bitcoin. So it says like 90% of circulating supply, right? So what it means, so the circulating supply, does that mean like 90% of 21 million, or like what does that mean?
Correct. So right now we have, I think, if I remember, if I've noted it down somewhere, that's right. That's a total circulating. So I think 18.9 million bitcoins is what has been mined so far. So that will be the circulating supply.
So
Again,
does that mean, right, when it reaches the cap of 21 million, right, it's no more going to be mined?
Correct. It will not be mined.
Okay.
So I don't know what metric you're exactly looking at, whether you're looking at market cap or whether you're looking at number of coins mined or number of active coins. I'm not sure what metric you're looking at.
No,
but
I'm not looking at the market cap or volume. I'm looking at the circulating supply. So which says like 19 million.
Correct. Correct. I just approximated. So 19 million is a circulating supply.
Okay.
So
Yep.
that those are the mined coins, right? So if it is 19 million, we just have another 12 million to be mined.
12 million or 2 million?
Oh, sorry, 2
20.
million. 2 million to be mined.
Okay, got it. Yeah. It was a great session so far. Sorry, Krishna, to interrupt you. Please go ahead.
No issues, no issues. Thomas, you can tell me when to stop because we are running out of time, but I have some more. So in case we are running out of time, you can check and then we can do another session later. Shall I continue, Thomas?
Yes, sir. Yes, sir.
Okay, cool. So we'll look at some practical use cases of blockchain. If we look at Bitcoin has been the native blockchain, which completely looked at only writing things, very rudimentary things about cash pay or payments between 2 or 3 parties. That is when there's a guy called Vitalik Buterin who invented the Ethereum. So what he looked at is he looked at Bitcoin. He got super interested in Bitcoin and realized that okay, there is a lot more potential that we have than just having transactions written to a ledger. Why can't we make the code itself the king by doing something called smart contracts? That is, if this works, if this condition is met, then something needs to be done, right? So he brought in the concept of smart contracts. So smart contracts is nothing but like you can look at an if-else condition. So let's say a very an example I will tell you which we can get to is let's say I decide to buy a property and you decide to sell a property. So let's say Thomas wants to sell a property for somewhere between 10 lakhs to 15 lakhs and I am ready to buy a property for around that amount. So if Thomas and I agree, I don't need to know Thomas at all, right? That's the case here. If Thomas and I agree on a common amount, okay, this is what it works, then automatically the transfer of that property on the ledger can be to me. So in this case, if you look at it, we did not have, no, I can give you real life example, but just to keep things short and make it easier for a person to understand is what I'm saying. So let's assume that there's a property A which is registered in the ledger, which means in that Excel sheet, which says Thomas is the rightful owner of it, right? Let's not question that. Let's assume that is there, and I as a person wants to buy it. I don't know Thomas. I've just seen the property and I like the property, and then I go see and I see the property is for sale on the blockchain network. So then I say I am ready to buy the property for 11 lakhs, and then I enter that I am ready to buy the property for 11 lakhs. Automatically the property title will change to me because Thomas was ready to pay for to sell the property between 10 to 12 lakhs. So because the amount that I put meets the condition, the code itself decides that the title has to change to me, and in the ledger my name will be now the new title, which means now I am the owner of that property. So what this cuts off is, this cuts off the complete registration office, the different stamp duty charges, the concern that whether the title is really Thomas's or not, or whether it is mine, because it is immutable. Because the blockchain is immutable, you can always go back to history and know complete history of who all owned that title, right? So this brings in a powerful concept of this smart contract, where we can do a lot of decisions and a lot of transactions without a third party involvement at all, right? So one example is Cardano is doing something in Africa. So Cardano is a blockchain, and generally in Africa, what they are helping the housing market there. So if you want to take a housing loan there, it is around 40% to 50% as the interest rate that you need to pay to the banks. And if you're doing a foreign exchange remittance, which means sending money from anywhere to certain countries in Africa, the rate that you need to pay as charges varies from 5% to 25%. Why is all this there? Because there are intermediaries involved. Now, when a foreign transaction happens, when we send a money through Swift transfer, it is not as simple as what we see it as. As a consumer, I think I have sent the money, but at the back end, from the banking process, there's a lot of work that happens from the bank that you send to the Reserve Bank, to an intermediary, to that country's Reserve Bank, to this. So there's a lot of lot of middlemen involved in the transfer, which means there is a cost to it, which has to be borne by me and the receiver, right? When you look at these kind of blockchains, there is no intermediary. It's just between me and that other person. So that cost is cut. So what Cardano does is, if you have a Cardano, you can do it's not donated, you can actually lend it to there's a company called Empova that's which is working on the blockchain of Cardano. So you can say, okay, I am giving like 10,000 ADA. So ADA is the Cardano's current, like how we are saying Bitcoin, it's ADA. So I can say 10,000 ADA, I am giving it, I'm lending it to an African, to Empova, so that they can use that money to build a house in Africa. So when I send the ADA to the Empova, all this is through smart contract. So you can actually have traceability. What Empova does is, Empova takes ADA, looks at the current market price of the local currency, fixes that currency rate between my ADA and that, withdraws that currency, it goes to a builder who builds the house, and whoever is the owner of it, whatever they are paying back, again gets converted to ADA and it comes to me. So if I have excess money in terms of ADA, I can buy ADA, and if I can actually lend to cross-border, cross-country, to wherever it is needed, by completely cutting off middlemen. So where a person in Africa, instead of paying 30%, 40% interest on this, here they may be paying as low as 1%, 2%, 5%. In fact, again, I mean, we will run, we will cross time if I talk about DeFi, but there are decentralized finance and exchanges where if you can actually put your coins and you can withdraw money and not have to pay a loan at all. So if you want to buy a car, let's say if you're having a Bitcoin, let's say you've got one Bitcoin, it's like $30,000, $40,000 right now. You can put the Bitcoin in these decentralized exchange, withdraw money of probably 60% or 70% of that money, go buy a car, go buy a house, whatever you want. And all you need to take care of is if the price of the Bitcoin goes below a particular level, that exchange, that smart contract will all automatically liquidate it, which means you lose the Bitcoin. So as long as the price is above that, you don't need to bother about paying at all. I think that's another topic. Probably we can, because I think we are already going to 7 o'clock. If needed, we can have another discussion sometime later. But smart contract as such brings in this capability, which is beyond what a Bitcoin does. So Solana is trying to bring this smart contract where you can, so the transactions per second is quite high in Solana, as good as Visa, MasterCard, which means we can use it in exchanges, we can use it, there's a lot more practical purpose of using, where like how Visa we can use Solana. Bitcoin transaction is very less. It's around only 7 transactions per second, so which is quite low. Which is why the adoption of Bitcoin as a payment system, which Satoshi Nakamoto thought of, has not yet happened, but it's now converted to a value proposition. There are there's one country which is actually moved to making this a legal tender. El Salvador has done that, where in El Salvador you can go and you can buy things in Bitcoin. It's a legal tender. But I think I'll just stop here because if I go to the next topic, which is on DeFi and etc., that will take a lot more time.
Krishna, great session. So I'm sure that you would have gone through that learning cycle about like crypto, blockchain, or whatever it is. Okay, let's say if there is someone like a beginner, right, who is interested to get in deep into this learning of this crypto and then blockchain or whatever it is. So is there some so probably this is you have a practical experience in learning this thing. So this is where somebody has to start. Okay, and these are the different areas within it. Okay, so can you just briefly provide a pattern, right? Okay, how someone can learn crypto and blockchain, right? Like what are all the different things and where you could just find these articles, or what is the best way to learn about it?
So I learned a lot through multiple YouTube channels. So I can tell some of them, but what we need to know is there is always a hidden agenda behind every YouTube channel. They are either pumping the coin, so don't go by what YouTubers are telling, but you can kind of get information. And I have a blog, so I have so many people have been asking me about these things, so I've started writing about the blockchain and the different this thing. So you can look at me at unthinking.org. That's my website, unthinking.org.
Sure.
So I will be right now there are only few articles on the Bitcoin stuff, I mean on the crypto stuff, but I plan to write a lot more. Other than that, if you're looking at YouTube channels, Coin Bureau is a good one. Then there is something called Invest Answers. That guy does you can't learn much about crypto from that, but that guy tells you about trading, and he goes even into US stocks, etc. But Coin Bureau is, I think, is a very good channel which covers a lot of basics about this. Then there's something called Altcoin Daily. So if you're getting into trading or investing, then Altcoin Daily will every day they will tell what's the news that's happening. That's like just a 5-minute, 10-minute, you will know what's happening. So I would suggest Coin Bureau is what will give you a lot more information.
So the YouTube sites Coin Bureau, and then I think you were saying about Altcoin Daily. What was the other one? I think I missed the second one.
Invest Answers.
Okay, thank you.
Other than that, you can go to coingecko.com to see all the market cap coins and etc. But one thing what I would tell is we are probably starting or started the bear market. No one in YouTube will say it because everyone is on OPM, but chances are everything will crash. We don't, because there was a lot of liquidity pumped in because of this what we discussed earlier in March 2020. So people got free money, they didn't know what to do, so they pumped. All the markets have gone up from the Indian market to US. Yeah, so if you're planning to you can probably do your own research. DYOR is like the standard.
Yeah, got it. I mean, there is a lot of liquidity in the market, and again, right? Okay, so and again, I'm not talking in terms of trading. So I've been doing trading, I've been investing in crypto, but that's a different topic, as you said, right? That's why you have just put a clean disclaimer, right? It can crash anytime. So yeah, so I'm just asking more in terms of learning and stuff, right? Something like a smart contract, right? Okay, so it's definitely an okay, good thing to learn. So that's where I was just asking the pattern, right? Because you cannot learn something more advanced even before you know the basics. So that's why I was just asking that. Okay, thank you.
So that's one, and that's what you can look at my blog, and if you have some suggestions, you can ping me or tell me. I will write about it, and then Because
Definitely,
that's
Krishna.
cool. Thanks a lot. Thomas?
Yeah, Krishna, one last question from my side. See, if I have a shop and if I have a Bitcoin wallet and if somebody purchases using Bitcoin, I can give him the product, isn't it?
Yes.
So, though it is not a legal tender note here, I can have an exchange of Bitcoin to my wallet.
Yes.
Okay, fine. Thank you.
You can do that. So only thing is you will have to take the, I think someone had asked, right, like what the prices are fluctuating in, etc. So that's where the uncertainty comes into picture. Like for example, if you look at El Salvador, they are looking at some kind of a capping of the amount or something like that. So if you're ready to uh, take the fluctuation, because it could be that someone is buying for like $100 and then he's giving you $100 worth of Bitcoin, and then tomorrow there is a crash and that $100 is only worth $40, or it could be the other way, that $100 may be worth like $175, right? So that's the challenge that we have currently. But if you're looking at the long term, if you're not planning to use this money right now, over the from 2010, if you look at it, the price has only gone up because we are pumping so much of money. So the price of Bitcoin has only gone up. So if you're having a horizon of like 3 years, 4 years, probably it would have like doubled or tripled.
Yeah, thank you. And this budget, I believe some 30% taxation is being done this time. I think
Yeah.
it is put on papers. Yeah.
So that is only
well,
when you're if you're trading. So if you're hodling, see, there is another thing. These you shouldn't keep these crypto like in the exchange. It's not like how you keep it in a bank account. You should have self custody of it. So once you buy, if let's say Bitcoin is like the blue chip in crypto. If you're buying Bitcoin, you should not keep it in the exchange, because the exchange can close. There are so many examples we have had, like Mount Gox and etc., where exchanges just close and then you've lost it. So that's why there is a saying in crypto: not your keys, not your coins. So you can actually withdraw it, which is another advantage, which probably I should have told earlier of Bitcoin. I can withdraw it to a blockchain, which means withdraw means it doesn't come to me, but in the blockchain it comes to be that I'm the owner of it. And if I have the key to that, I can just go to any country, anywhere, and then I can access it. No government or no single person can take ownership of it. So that is something that you will have to. So even now, from what I understand from what the government has told is for trading, which means you buy and you sell and then you convert it back to fiat currency, then you pay 33% or 30% or whatever. But if you're buying Bitcoin and then if you're withdrawing it to your hardware wallet or some wallet, maybe that again can be another session on that, you are withdrawing it, then the government will not charge because you've not yet converted it.
So basically, it's 30%
great.
on the gains actually, which I think personally, right, it's utter stupidity. So it
Yeah.
should be like included to your income, and then right, you should be taxed for your total income. Non specifically 30% for digital currency gains, right? I think right. So pretty much in US, right? It's like it's added to your income, and based on the total limit, right? You get the tax percentage. In fact, right, I read very recently that there is some proposal to, like, if somebody is gaining like less than like some $200-300, right? They're not going to be taxed. But this 30%, right? I think right, it's not going to take the way forward. It's just definitely a lagger actually. But
True.
maybe it's like lot of people in India. I heard that they are, without knowing much about right the cryptocurrencies and stuff, right? They are kind of like investing very crazily in lot of cryptocurrencies, right? Without right because it has that potential to just give 1,000% returns kind of stuff. So, but that could probably limit this, but in a way, right, more in terms of technology and other stuff, this is going to be a limitation, right? Yeah.
In fact, you can't claim for the losses. So if you have lost, you've lost, but if you have gained, you have to pay.
Of course, of course. Yeah, it has to be simple. It has to be simple. It has to be added to any of your income, and based on the tax limit that comes in, right, you have to be deducted. But yeah, either way. So we are way far, like at least in India, like in terms of having some loss. So Krishna, like maybe I think we would have missed on this part. And again, right, that's a different topic, right? On the regulations and see one thing, right? Even though right, it's a secure transaction, right? Okay, so the more and more, right, you have laws and regulations around that, people will start trusting that cryptocurrencies, right? So I think maybe it would be good to cover about it whenever you take the next sessions, right? Typically, what kind of regulations are at least they are trying to introduce in the near future. So that would be great session to have.
Sure.
Sure, a great session. Audience, if you have no other questions, Krishna and Vasant, shall we have the closing remarks?
Yes, Thomas, sir.
Yeah.
Hello.
Thank you, Krishna R. Yes, Vasanta. Shall I go for the closing remarks? Yeah.
Yes, Thomas. Yes, Thomas.
Yeah, thank you. So that was Krishna R of 2003, mechanical passed out. Thank you, Krishna. SRE's Alumni Association is proud to host you this evening. Really, you have made some awareness on cryptocurrency and blockchain, which really in India is a new beginning. I don't know how it goes forward, but still definitely an eye-opener for all the listeners today, all those who have joined this call. Thank you so much. Thank you, Department of Mechanical Engineering, for introducing Krishna to SRE's Alumni Association. Thank you, Krishna, for joining us on a short notice, what we were able to give you. Thank you so much. It's alma matter what you have made and yes to the invite. Thank you so much. Thank you, audience from all over the globe. We had Anand from US and a few others in the call. Thank you so much for joining us. Thank you, student friends and faculty members for joining this particular webinar talk number 87. Thank you so much.
Thanks a lot, everyone.
Thank you, everyone.